Hello, everyone. This is Sebastian McMahon from IA Financial Group. I'm here to bring you the weekly economic review for the week ending March 12, 2021. So it's starting to smell like spring, and we have lots of things to discuss today with our chief economist, Clément Gignac. So good morning, Mr. Gignac.
Good morning.
So markets were interesting this week. I'll start with the view on the week. So as you can see, pretty much all green this week for both equities and for fixed income. But this is at the close on Thursday. As we are recording this, we're Friday morning. The markets are in the red. Interest rates are rising. So maybe the picture will be changing, but it would be surprising to see the stock markets turn all to red because that was still a good streak of 4 days. Interest rates a bit lower for the first 4 days, so that helped the returns on fixed income. Equities, as you can see, the Nasdaq had a strong rebound on the week, 3.7%, although this morning it's under pressure. And the other markets, well, very nose to nose on local currency between 256 and 258 for the S&P 500, the TSX and AFI. Emerging markets lagging a little bit, but still rebounding after a tougher month here for emerging markets. Price of oil is pretty stable. The Canadian dollar higher on the week. The US dollar is strong, but the Canadian dollar is even stronger, so that's a good sign for the CAD. The euro up, and the price of gold up 1.3% on the week. So maybe doing things differently, a look back at the last 365 days, because this week it was exactly 1 year to the week that the World Health Organization announced a global pandemic for COVID. So here, I won't be going through all of the numbers here. If you're a financial advisor, you can use that with your clients, or if you're an investor and you're a fan of history, well, you can print this out and say that, well, I was invested in a year where the price of oil went from 60 to 20 all the way to 70, the S&P 500 from 3,300 to 2,200 to almost 4,000 within a year. The economic data, as you can see, it was all over the place. The labor market in the US, we went from creating 315,000 jobs a month to at some point erasing 20 million jobs within 1 month, and now back to recreating 379,000 jobs during a month. So very very telling picture here of the last year that we just went through. And also one of the most surprising things of the last 365 days is on the right. Mr. Biden yesterday came out on live television saying that he expects every adult in the US to be vaccinated by May 1st. Of course, it's quicker than in Canada here because they have the production facilities in the US. That's the way things are. But still, that's a very fast pace and a very fast turnaround in the vaccination effort. So very telling picture here of what the last year was like. Vaccination, as I bring every week on the right, perspectives on vaccine rollout. Here, there's a change in methodology compared to the previous few weeks. Before, it was the number of doses administered per 100 people, but many people have had 2 doses. So here, it's the share of the population that have had at least 1 dose. So in Israel, it's 60%. After that, you go to the US and the UK, where it's at 33 and 18%. Canada is at 5.4. The pace is pretty slow. Elsewhere in Europe, also it's pretty slow. But we've learned this week that Canada now expects to have at least 38 million doses being shipped before the end of June. So expect a very quick pickup in the pace of vaccination here. So pretty much every Canadian could be vaccinated at least once by the end of June if you do the math. So that's a very interesting development here. Talking about the interesting developments, well, in Washington now, the checks are in the mail. Mr. Biden did sign the $1.9 trillion COVID relief bill. So it's done. He said that checks could be in the bank accounts of the citizens as soon as this weekend. Now that this is done, the other phases were the COVID response. So we did discuss that yesterday. As I mentioned, by May 1st, every American could be vaccinated. And the next step after that would be the infrastructure plan, which could be another $2 trillion over the next 10 years. So lots and lots and lots of stimulus here, many good news leading to a strong, booming US economy. And as you can see here on the left, you have the past growth rate quarter. This is a year per year, rather, for the US economy. As you can see now, the consensus is at 6% this year. That would be the strongest growth since 1984. And we're already seeing some economists coming out say, well, we could have 6.5, 7, 8, or even 9%. So expect a very stellar year. 9%, that would be even better than what we had in 1984. So it's the possibility. And on the right, we were one of the most optimistic people out there at the beginning of the COVID, thinking that we would have a V-shaped recovery on the economy. We knew that central banks and the governments were there to help. Well, we did not expect that much help. We did expect this to unfold, but the strength of the stimulus is pretty astounding. It's a $28 trillion of stimulus that have been pumped by central banks and governments in the last year around the world. So that's pretty strong. And as you can see on the right, with the Biden package, we could go back to the pre-pandemic trajectory that we had as soon as Q3 of this year and even overshoot that. So that's a very, very positive development. They are doing even more than we expected when we were pretty optimistic at the beginning of this thing. So pretty astounding development that we're seeing here on the fiscal side. Canada's labor market here, we created 259,000 jobs in February. That was a strong beat. Expectations were for 75,000. As you can see, the red line here, we were losing pace in Canada, and now we regained pretty much all of it. Remember that in January we had lost 212,000 jobs. So now it's 80% of the lost jobs that have been regained in Canada compared to 58 only in the US. So that's a very positive development that we see here. It's mostly about services. So the sectors that were more hit by COVID, like restaurants, are at the forefront of this. But as we will be reopening more and more and more going into the summer months and with the vaccination, we'll expect many more very good news here from the labor market in both Canada and the US. Finally, on my end, the Bank of Canada, no change to guidance yet, but they seem to be worried about housing prices. So on the right, this is an analysis from our friends at National Bank. As you can see, the red line is the share of regional markets whose prices are rising by 10% or more in the last 12 months. So it's even higher than it was in 2016, when the governments had to come out with macroprudential measures to remove some fraud. So we're not in the bubble yet, but there is some fraud in governments, and regulators at some point could be forced sooner rather than later to put more macroprudential measures in place to make sure that you don't have any excesses in housing. So this is to follow. So that wraps it up for the economic part. So now looking at financial markets, I will hand it over to you, Clement.
Thank you, Sébastien. Very interesting time. Who could thought a year ago that, in fact, you will have a new president? Biden mentioned that you will almost all American adults will be vaccinated by early May. So what a great news. But when you have a great news on the Main Street, it could turn out as less good news on Wall Street. We will try to understand that. But let's take the optimistic approach to start with. After that, I will start to nuance a little bit.
So maybe just your camera is still close. I know people like to see you when when you share your knowledge.
Sorry about that. Okay, I appreciate. So basically, Wall Street so far, people are optimistic, continue to be optimistic, because guess what? Americans will receive not only vaccine, but will receive money in addition. $1,400 coming in the mail. And a lot of people, what they have done with the money they have received last year, they have put money at work, and they have bought stocks, possibly in the NASDAQ. You remember Robinhood platform increased popularity. On the left side, notice here the young retail investors. Maybe the survey from Deutsche suggests that half of their money will be injected in the stock market. So we can take a positive view. So notice the significant purchases of retail investors recently. In the last few weeks, they have even accelerated. We talk more than in fact, billion a week, which is very, very important to inject money in the stock market. So people receive money, what they do, rather than go to a restaurant or travel, they are unable to go to a restaurant or travel, put money on the stock market. And to illustrate, on the right side, you have now the retail investors who are more important in terms of trading to explain the volume on the stock market than really the mutual fund and hedge fund combined. So that tells you something very, very important now, their role. So this is the optimistic view. But guess what? With the great news that we have from Biden, vaccination, and all that, that means that maybe you will have more booming economy. And we have booming economy where maybe more pressure on interest rate. To illustrate my point on next page, we talk about the yield curve, because make no mistake, central banks control short rates. Central banks do not control long rates, except if they adopt yield curve control, but they refrain to adopt yield curve control. Bank of Japan doing that. But not the Federal Reserve or Bank of Canada. So as a result, with the upward revision of economic expectation or inflation expectation, the yield curve steepening. And notice the 10-2 year here, the spread is above 140 basis points. It's the highest since 2014. On the right side, we compare that reaction to the previous business cycle. Notice the dotted green curve is the average of the behavior of the yield curve following a recession. So Sébastien has I found that chart. I found that very interesting. So we have many recessions in the past, 1981, 1990, 2001, 2008. So what happened to the yield curve after the recession? Okay, so you can notice it's all over the map. But so far, the dark line illustrates the current example in the last 12 months. And now you can notice an acceleration of the yield curve. This is what I explained on the left side. So bottom line, be prepared that this steepening yield curve is not over yet. It's not finished. Central bank want to keep interest rate low. They keep optimistic message that inflation pressure is temporary, but investors are skeptical. They see big money, big spending from government, inflationary pressure. So for all of this reason, we have a situation that the yield curve could continue to steepen, and with our interest rate, you could have pressure on stock market. That's the reason I mentioned great news for Main Street could turn out as a more hostile environment for Wall Street. On next slide, for example, it's on the NASDAQ. Okay, NASDAQ is probably the index who has a much downside risk given the upward pressure on interest rate, because people are choosing growth stocks, technology, rather than banks and energy last year. But notice in the last few weeks now, you notice the acceleration of the banking stocks, improvement energy stocks, and downward pressure on NASDAQ because the people are concerned about the interest rate increase. Do not forget, these NASDAQ stocks are a long duration if you want. So, and that affect the cash flow, the current cash flow, or the present cash flow, I have to say, present value, if you have our interest rate. Here is the relationship, correlation between IEF, which is an ETF, which is treasuries 7-8 years duration. So you can notice, and the QQQ, which is NASDAQ. Never in a decade, bottom line, never in a decade you have seen such correlation between the bond yield, long bond yield, and NASDAQ. So what that suggests, that if bond yield continue to accelerate, to increase, you will have downward pressure on NASDAQ. That's basically what the story tells us. And to conclude on that, on next slide, very interesting chart coming from BIS. It's in fact on the it's on the they have produced that. So basically, what they have done, they have analyzed stock market reaction to economic news and monetary policy news. So you have the pink bar, if you want. Hoping my color is okay. Pink is in fact the impact of economic news. And the blue one, the blue bar, is the impact of monetary policy news. You have two categories. The first category is when you have a high CAPE ratio. The CAPE ratio is in fact the price market cap divided by earnings adjusted for the business cycle. So we have a high price earning ratio, a high CAPE ratio as we speak, nothing new. But in addition, we have a high CAPE ratio in the context of very low interest rate, which is the second bar on the right. You can notice when you have a context like that, very high CAPE ratio with very low interest rate, you have suddenly a situation that it's more monetary policy news. Liquidity matters more than non-farm payroll, for example, or retail sales. So economic news are less significant than the expectation of liquidity shift. So bottom line, the bar is pretty high for next Wednesday when the Federal Reserve will release its minute and press conference from Mother Powell on the FOMC meeting, because if the communication have some concern, we could have a situation that the bond yield will continue to rise, and that could put further pressure on stock market. It would be very interesting to watch, but it's the exit strategy for central banks is not easy. And if they have any misstep in terms of communication, that could set the table for a significant correction on the stock market. We will see. Hoping I'm wrong, that everything would be smooth, but clearly we have a situation of turbulence possibly coming in the coming weeks or coming months, given the fact that this economy will rebound much faster than expected, and central banks has to consider an exit strategy maybe earlier than what they have communicated so far. So I was long a little bit, Sébastien, sorry about that. Beyond FOMC meeting, we have other things to watch next week. Huh?
Yeah, sure, sure. Thank you. So we have in Canada, we'll have a few things: housing starts, manufacturing sales, inflation, and retail sales. Inflation, it was at 1% in January, should be still subdued in February, but starting from next month, so in 4 to 5 weeks, when we get the next figure after that, we should start to have some favorable comparisons year over year. So we should start to see inflation accelerating. Central banks say, well, it's temporary. We should look through that. So we'll see what the markets think about it. In the US, we should have the retail sale, industrial production, housing starts, and most importantly, as you mentioned, the FOMC rate decision should be stable on the rate, but we'll see what they say and how they address the rising rates. So very interesting meeting next Wednesday, 2 p.m. Eastern time. So as usual, you can always follow us on ia.ca/economy. If you haven't subscribed to the newsletter, you can do it where you have the red arrow here. As I always mention, if you want a PDF version of this presentation, you can write at economics@ia.ca, and we'll be happy to send it to you. So thank you everyone for your business. Thank you for your trust. Thank you, Mr. Gignac, for your insights.
You're welcome, and have a nice weekend.
Thank you, you too. So we'll be back next Friday with another edition of the weekly economic review.